KOSPI falls 1.79%.
Hey everyone, I'm Lauro, and welcome to The Explainer. We've got a massive tech sell-off in the Asian markets to dissect today, so we're keeping the data sharp and the analysis fast. Let's get right into it.
Okay, let's start with the hard numbers. The KOSPI took a significant hit today. It basically erased recent gains, closing down nearly 2% at 6,788.88. It's a really sharp contraction, and honestly, it demands our immediate attention.
So what exactly dragged the whole index down? Well, the anchor weights were unmistakable. We saw massive sell-offs in our foundational tech heavyweights. Samsung Electronics dropped 3.38%, and SK Hynix, they plunged an even steeper 4.45%.
Trigger 1, AI chip growth.
Looking across the Pacific, Marvell Technology actually met their overall market estimates for revenue and earnings. But in today's hyper-competitive climate, just matching isn't really enough. They miss the market's sky-high expectations for custom ASIC and AI chip growth. Investors were banking on this unstoppable boom in AI infrastructure, right? So when that rapid acceleration wasn't confirmed, it triggered immediate disappointment across the board.
Trigger 2, tariff threats.
Then, reports surfaced that Washington is looking into expanding its semiconductor tariffs. But here's the absolutely crucial detail. This expanded scope wouldn't just apply to the chips themselves. No, it would potentially cover the finished products built with them. We're talking laptops, data center servers, gaming consoles, the whole shebang. Think about it. If tariffs hit those finished products, import prices in the US naturally shoot up. And those higher retail prices, they could significantly dent end consumer electronics sales. And if people buy fewer electronics, that directly slashes the demand for the memory chips sitting inside them.
Now, bring this back to Samsung and SK Hynix. Both of these giants are deeply exposed to these global supply chains. So you take the dual threat of slowing AI chip growth, combine it with the fear of finished goods tariffs, and you've got a perfect storm. This severely lowered demand expectations for their advanced high-bandwidth memory, or HBM chips today.
And you could literally feel the resulting panic. We witnessed a staggering 1.76 trillion won foreign exodus from the KOSPI today. To put that into perspective, over half of that selling, about 960.6 billion won, was concentrated in just 3 tickers: Samsung Electronics, SK Hynix, and Samsung preferred shares. Just massive outflows. Trigger 3, the Bank of Korea rate hike.
So, bringing it back home, the Bank of Korea officially raised its base rate by 25 basis points to 3%. This move instantly raised corporate funding costs, which basically adds intense local friction for equities right on top of all that global tech anxiety we just talked about.
It's like the market was being squeezed from all sides. Trace the sequence with me. We had the BOK hike yesterday. Then, overnight, U.S. Treasury yields rose across the curve, mostly thanks to rebounding oil prices and geopolitical risks in the Middle East. And today, that pressure carried right over, pushing the Korean 10-year yield up 3.5 basis points to 4.280%. So why does this matter so much for tech stocks specifically? Well, it all comes down to a fundamental principle of valuation. Rising long-term yields increase the discount rate applied to future stock earnings. So you've got lower earnings expectations from the AI and tariff fears colliding head-on with higher discount rates. This heavy collision intensifies the broader tech sell-off, essentially repricing risk right in front of our eyes.
The canary signals beneath the surface.
Okay, let's look at the hidden signals, because we spotted a few major anomalies beneath the surface today. First up, despite that massive foreign stock sell-off, the Korean won actually strengthened to 1,372.4 against the dollar. Why? Because that BOK rate hike we mentioned narrowed the Korea-US policy rate gap to 0.75 percentage points. That lowered the incentive to dump the won. Meanwhile, short selling absolutely plagued SK Hynix for a third straight session. And get this, foreign sentiment on Samsung completely flipped. They sold over 500 billion won in a single day, erasing half of their buying spree from just the prior 2 days.
But it's not all doom and gloom. Fortunately, there is a massive wall of corporate defense buffering this fall. Both of these companies are aggressively buying back their own stock. Samsung is executing a 15 trillion won buyback, and SK Hynix is deploying a staggering 40 trillion won program. This continuous daily buying is acting like a critical floor, really keeping the losses from spiraling out of control.
Institutional capital rotation.
With the tech sector bleeding, you have to wonder, where did all the money go? Well, institutional capital pivoted rapidly. They poured net buying directly into the machinery sector, specifically targeting Doosan Enerbility to the tune of 71.6 billion won. This comes right on the heels of fresh news about a U.S.-Korea proposal to jointly acquire a stake in Westinghouse, so the momentum behind nuclear energy is exceptionally strong right now.
Capital also saw immediate refuge in chemicals. Institutions were chasing the highly profitable K-beauty export narrative, which really lifted cosmetic stocks like APR, Amore Pacific, and Cosmax. We also saw a sharp opportunistic rebound in refining stocks. S-Oil actually jumped a massive 9.14% today, riding on the back of those rising global oil prices.
So, this brings us to the ultimate question for you to ponder. With these massive buybacks acting as a floor for our tech giants and capital violently rotating into machinery and cosmetics, is today's massive sector rotation a permanent structural shift in the market? Or is it just a momentary panic over AI growth and tariff fears? Let me know what you think. If you'd like to receive news on the closing of Asian stock markets before the New York market opens, please make sure to subscribe. Thanks for joining The Explainer, and I'll see you next time.